Right now, across California's wealthiest neighborhoods, house prices are crashing harder than most people realize. In Beverly Hills, the average property just dropped by $280,000 in a single year. Palo Alto saw prices plunge 15.2%. And this isn't just affecting tech millionaires in their Silicon Valley estates. This is the beginning of something much bigger that's about to ripple through the entire California property market in ways that will determine whether you can afford to buy, whether you'll be forced to sell, and whether your home becomes your greatest asset or your biggest financial mistake. Write in the comments, California property warning, if you're concerned about what's coming for real estate values. Because what's happening in California right now is exactly what happened before every major property correction in American history. The expensive areas crack first. Then the pressure spreads outward like a shockwave, reaching every corner of the state. And by the end of this video, you're going to understand exactly why this isn't just another market dip. This is the start of a genuine tank. But first, make sure to subscribe to USA Housing Truth, because we're bringing you the real story behind the headlines that everyone else is too scared to tell you. All right, here's what nobody in the California property industry wants you to know. The California housing market just entered a phase that economists call capitulation. That's the moment when sellers who've been holding out for higher prices finally give up and accept reality. When properties that were confidently listed at $900,000 8 months ago are now quietly reduced to $780,000. When real estate agents stop returning your calls about viewings because they know the seller is about to pull the listing and drop the price again. We're watching the psychology of the market completely reverse. And once that reversal starts, it feeds on itself in a way that's almost impossible to stop. Stay right here, because what I'm about to reveal next shows you exactly why Elon Musk leaving California was the warning sign nobody took seriously. Let's start with what's actually happening on the ground right now. The median California house price officially sits at $780,000 as of September 2025. That sounds relatively stable on the surface, but that statewide median is hiding something absolutely massive. Bay Area house prices dropped 2.3% year over year. That's the only major region in the entire state seeing annual declines. But it's not just any decline. This is happening while Central Valley and Inland Empire are still showing modest growth. Fresno is up 5.1%. Bakersfield is climbing steadily. But the Bay Area, the place that's supposed to be bulletproof, the tech capital that always bounces back, is actively falling. And here's the thing. When the Bay Area falls, it doesn't happen because of local factors. It happens because something fundamental in the California economy has broken. Think about what the Bay Area represents. It's where the highest earners in America live. It's where tech wealth parks itself. It's where property has been treated like digital gold for the past 15 years. If wealthy tech executives with massive stock options and excellent credit can't sustain prices in Palo Alto, what chance does the rest of California have when the economic pressure really starts to build? The cracks are already forming. Transaction volumes are down 32% year over year in the Bay Area. That means fewer people are actually buying, more people are trying to sell. And the gap between supply and demand is widening every single month. When you've got sellers flooding the market and buyers pulling back, there's only one direction prices can go: down. Don't you dare click away, because what comes next exposes the exact moment when California's luxury market entered freefall. Now here's where things get really serious, and this is the catalyst that's going to accelerate everything you're seeing. Elon Musk moved Tesla headquarters out of California. Marc Andreessen, one of Silicon Valley's most influential venture capitalists, quietly started selling Bay Area properties. Tech executives who built billion-dollar companies are leaving the state they made wealthy. This isn't about politics. This is about math. When the people who created California's tech wealth look at their property tax bills, their state income tax, their cost of living, and decide it's not worth it anymore. That's a signal you cannot ignore. But it gets worse. California's mansion tax and increased transfer taxes hit in 2023 and 2024, fundamentally restructuring who can afford to buy luxury property and how much it costs to do it. In Los Angeles, properties over $5 million now face an additional 4% transfer tax. That's $200,000 in pure tax on a $5 million home. In San Francisco, luxury property transfer taxes jumped dramatically. If you're buying a $4 million home in Pacific Heights, you're paying over $160,000 in transfer taxes alone. That's money that could have gone toward renovation, furnishing, or simply stayed in your investment portfolio. Instead, it's going straight to the state as pure tax. According to real estate data analysis, the average luxury buyer in the Bay Area now pays an extra $78,000 in transfer taxes compared to 3 years ago. In neighborhoods like Atherton, Palo Alto, and Los Altos Hills, that figure jumps to $135,000. For buyers who are already writing million-dollar checks for down payments, an extra $100,000 in upfront tax is often the difference between buying and walking away entirely. And wealthy buyers have options. They can buy in Florida, Texas, Nevada, states with zero income tax and lower costs. Keep your eyes locked here, because what I'm about to expose next reveals how Beverly Hills became ground zero for California's real estate collapse. The result? Luxury buyers are exiting California in massive numbers. Properties above $3 million saw sales drop 18% year over year. New luxury listings are down 12% because sellers know nobody's buying at these prices. That's creating a devastating feedback loop. Luxury market freezes, prices start dropping to attract any buyers, but buyers are still cautious because they think prices might drop further, so they wait, which forces sellers to drop prices even more. This is a textbook capitulation spiral, and once it starts, it's incredibly hard to break. Now let's talk about the other force that's squeezing California homeowners right now. Mortgage rates combined with property values that make no sense. Between now and the end of 2027, roughly 2.2 million California homeowners are going to watch their fixed-rate mortgage deals expire. These are people who locked in rates at 2.5%, maybe 2.8%, back when the Federal Reserve was practically giving money away during the pandemic. They bought their California homes thinking they could afford the monthly payments forever. And for the past few years, they were right. Life was comfortable. Payments were manageable. Everything seemed fine. But now those deals are expiring, and they're staring at refinance rates of 5.75%, 6.25%, sometimes even 6.75%. Let me show you what that actually means in real California money. If you borrowed $700,000 at 2.5%, your monthly payment sits around $2,760. Not too bad if you're earning decent tech salary. You can budget for that. You can handle it alongside your other California expenses. But when that deal expires and you refinance at 6%, that same mortgage suddenly costs you $4,190 a month. That's an extra $1,430 every single month. Over $17,160 a year. For California families already stretched thin with childcare costs that are astronomical, gas prices the highest in America, and state income taxes taking massive chunks, that extra $17,000 isn't just uncomfortable, it's genuinely unaffordable. Stay with me, because what comes next shows you the 3 options trap that's forcing California homeowners to panic sell. And if you think that sounds brutal, here's what makes it even worse. If you don't refinance and you just let yourself fall onto your lender's standard variable rate, you could easily be looking at 7.5% or even 8.25%. At 7.5%, that $700,000 mortgage costs you $4,890 a month. You're suddenly paying an extra $2,130 compared to your old deal. That works out to over $25,560 a year, just in additional interest. Nothing else has changed. Same California house, same loan amount. The only difference is the interest rate. For tens of thousands of California homeowners, especially the ones who bought at the absolute peak in 2021 or 2022 when Bay Area prices were at record highs, this is completely unsustainable. They stretched every penny to afford the property when rates were low. They told themselves California real estate always goes up. Now they're facing a choice that keeps them up at night. Find an extra $1,000 to $2,000 every month somehow. Cut spending on everything else. Cancel private school. Stop saving for retirement. Live paycheck to paycheck in expensive California. Or sell up before they're forced into an even worse position. And this is exactly why we're seeing inventory explode so dramatically in Bay Area and coastal communities. It's not that people suddenly decided they want to leave California. It's that they literally have no other option. They can't afford to stay. Here's what makes this mortgage crisis even more painful. There's a massive generational divide happening that nobody wants to talk about honestly. If you're over 65 years old in California, there's a 58% chance you own your home outright thanks to Proposition 13 protecting your property taxes. No mortgage, no monthly payment stress. You're sitting there watching your property value maybe dip slightly, but you don't really care because you're not planning to sell anyway. Your property taxes are locked in from decades ago. Life is comfortable. But if you're under 45, you're almost certainly carrying a massive California mortgage. And you're the one feeling every single rate rise like a devastating blow. Younger homeowners are holding the bulk of California's mortgage debt, which means they're getting squeezed the hardest, while older generations sit on enormous amounts of equity they built when property was affordable, and Prop 13 locked in their taxes forever. Don't go anywhere, because what I'm about to reveal next exposes why small landlords are fleeing while Wall Street buys everything. This isn't about blaming anyone or pointing fingers at different generations. That's pointless and divisive. It's just the mathematical reality of when people bought and under what economic conditions. But what it does mean is that the pain of higher interest rates is concentrated almost entirely on one specific group. Working California families in their 30s and 40s trying to raise kids and pay Bay Area mortgages simultaneously. And that group is now flooding the market with listings because they physically cannot afford to stay in their California homes. The properties hitting the market aren't coming from people who want to move. They're coming from people who have to move. Now let's look at what's happening with California landlords in more detail, because this is creating one of the most counterintuitive market dynamics ever seen. Small landlords, the ones with just one or two California properties, are exiting faster than anyone predicted. These tend to be accidental landlords who kept their old condo when they upgraded or inherited a property. They're not professional real estate investors. They don't have property management companies and tax attorneys. They're just regular people trying to earn some rental income in expensive California. And the new regulatory environment has made their lives absolutely miserable. California's strengthened tenant protection laws mean landlords can no longer evict tenants without specific just cause legal reasons. That sounds fantastic if you're renting. And in many ways it genuinely is. Tenants get more security. They can't be kicked out arbitrarily. But from a landlord's perspective, it adds serious financial risk. If you end up with a problematic tenant who stops paying rent or damages your California property, it's now much harder and way more expensive to remove them. The process takes months longer. Legal fees pile up exponentially. And there's no guarantee you'll recover your money in California courts. For a small landlord with just one rental property, one bad tenant can financially destroy them. Then there's the tax situation that's uniquely punishing in California. State income taxes are the highest in America. Rental income gets taxed at those same brutal rates. And with mortgage rates doubling from 2.5% to 6%, the numbers just don't work anymore. A Bay Area property that was generating $500 a month in profit 2 years ago might now be costing the landlord $300 a month after mortgage payments and taxes. They're literally paying money every month to keep tenants housed. That's not a business. That's financial suicide. And most landlords can't afford it, so they're selling. Keep watching because what comes next reveals the shocking truth about who's really buying as small landlords flee. And when these California properties hit the market, they're often snapped up by first-time buyers and families who were previously stuck renting. In a strange way, the landlord exodus is actually creating opportunities for regular people to get on the California property ladder. Former rental properties now make up a huge chunk of Bay Area and LA listings. In some neighborhoods, it's 1 in every 4 or 5 properties for sale. These tend to be well-maintained homes because landlords wanted reliable tenants, and they're being sold at prices below what they would have commanded 3 years ago. Because landlords are motivated sellers who just want out of California's regulatory nightmare. But here's the fascinating contradiction that should terrify you. While small California landlords are fleeing the market in panic, large institutional investors and Wall Street-backed companies are actually expanding aggressively. Investment property purchases in California surged 28% in early 2025 among institutional buyers. Yes, you heard that right. While nearly half of all small landlords are planning their exit, a smaller group of massive professional investors is actively coming in and buying up California properties at depressed prices. These aren't people who stumbled into real estate. These are BlackRock, Invitation Homes, institutional giants who understand the numbers inside out. They've planned for rate rises and built massive cash buffers. They see the current chaos as a once-in-a-generation opportunity to consolidate California real estate. They're buying properties from panicked small landlords at 20 to 30% discounts. They're targeting regions where rental yields still make mathematical sense, even with 6% mortgage rates. And they're positioning themselves to dominate California's rental market once the dust settles and small operators are completely gone. The Inland Empire and Central Valley are where institutional money is flowing aggressively. You can still buy a decent 3-bedroom house in Riverside for under $400,000 that'll rent for $2,800 monthly. That's a yield of 8.4% before costs. Even after maintenance, vacancy periods, and everything else, institutional investors are seeing solid returns. Compare that to San Francisco, where you might pay $1.4 million for a condo that rents for $5,000 monthly. That's barely 4.3% gross yield. After California's brutal costs and taxes, you're lucky to see 2% net. The numbers in coastal California just don't work anymore. Unless you bought decades ago and you're sitting on massive equity with locked-in Prop 13 taxes. But inland, in the Central Valley, and in parts of Southern California suburbs, there are still genuine deals if you're institutional scale and professional about it. Stay locked in, because what I'm about to share next reveals the market freeze that's trapping everyone. Now here's what absolutely nobody is talking about properly. Transaction volumes being down 32% doesn't just mean fewer people are buying. It means the California market has essentially frozen solid. People are completely paralyzed by fear and uncertainty. Buyers don't want to commit because they're worried California prices will keep falling and they'll end up massively overpaying. Sellers don't want to drop their asking prices because they still remember what their neighbor's house sold for back in 2021 at the peak. So everyone's just waiting for someone else to blink first, and basically nothing's happening. This creates a really strange situation where the California market data actually looks relatively stable on the surface, because there aren't enough transactions to move the statewide averages very much. But underneath, there's massive tension building, like a spring being compressed tighter and tighter. Eventually, something's going to give catastrophically. Let me show you what I mean with some real California examples. Zillow reported that the average new seller asking price in Bay Area dropped 2.4% in November 2025. That's a decrease of $28,000, bringing the median to 1.13 million. That's the steepest November decline in over a decade. More than 38% of listed Bay Area homes have had at least one asking price reduction. The average cut is 8.2%. That's the highest level since February 2024. California sellers are getting desperate. They're cutting prices repeatedly, adding incentives, offering to pay transfer taxes, anything to get buyers through the door. But buyers aren't biting because they can see prices are still falling month after month. And here's what makes this even more devastating. The California market is splitting based on price points in catastrophic ways. Sales agreed for homes priced above $4 million have fallen 21% year over year. New luxury listings in that category are down 14%. Buyers in these segments are watching and waiting. They're spooked by tech layoffs, tax increases, wealthy residents leaving California entirely. They're worried about everything, so they're not moving. But the sub-$700,000 segment, which accounts for about 68% of California's market, has been more resilient. Sales agreed are down only 6%. This is where first-time buyers and families are still transacting because they need somewhere to live in California. And they're finding opportunities from desperate sellers. Don't click away because what comes next gives you the exact timeline and predictions for California's continued collapse. So what does this all mean for the next 12 to 24 months in California? Let's be very direct about what's coming. Prices in Bay Area and coastal California are going to continue falling relentlessly. We're not talking about a crash where properties lose 40 or 50% of their value overnight. That's not how California real estate works with Prop 13 protections. But we are looking at consistent monthly declines of 0.7 to 1.3% that compound over time. A $1 million Bay Area property losing 1% a month doesn't sound dramatic. But over 12 months, that's $120,000 in lost value. Over 24 months, that could be $220,000 to $250,000, depending on how sentiment shifts. The mortgage crisis is going to intensify dramatically through 2026 and 2027 as more fixed-rate deals expire. Every month, tens of thousands more California homeowners are going to face that brutal choice between paying significantly higher rates or selling. Many will try to tough it out at first. They'll cut spending everywhere else, pull kids from private school, stop retirement contributions, defer all maintenance. But eventually, if rates stay elevated and tech job market stays brutal, more will be forced to sell. And every forced sale adds more supply to a California market that's already catastrophically oversupplied, which puts more downward pressure on prices. Transfer tax increases and regulatory changes are going to suppress California transaction volumes for at least the next 2 years. The mansion taxes and tenant protection laws effectively made buying more expensive and riskier overnight for almost everyone. Luxury buyers are paying hundreds of thousands more in taxes. Regular buyers face regulatory uncertainty. Landlords face impossible economics. When buying becomes more expensive and prices are falling and California keeps getting more hostile to property owners, rational buyers delay. They wait for better deals. They wait for lower prices. They wait for political change. This waiting game keeps volume suppressed, and suppressed volumes mean prices stay soft and falling. Here's what's critical to understand. Sacramento politicians are terrified of a California property crash, but they're trapped. Property wealth underpins so much of California's tax revenue. People borrow against their homes for everything. If property values fall sharply, it threatens the state's entire financial system. But they also need revenue, and wealthy residents are leaving. That's why they keep raising taxes on property and luxury goods, even though it's making the crisis worse. They're walking a tightrope. Keep taxing wealth and watch it flee the state. Stop taxing and face budget catastrophe. There's no good option. So what actually happens? My prediction based on everything we're seeing is this. Bay Area and coastal California will see cumulative price declines of 12 to 18% from peak to trough. That trough probably hit sometime in late 2026 or early 2027. Central Valley and Inland Empire will stay relatively stable, possibly even seeing modest growth in affordable pockets with strong rental fundamentals. Transaction volumes stay suppressed until mortgage rates fall meaningfully and California's political environment stabilizes. Probably not until late 2026 at the earliest. Forced sales from refinancing homeowners peak in 2026 and 2027, adding continuous brutal supply pressure. First-time buyers in affordable inland regions find genuine opportunities, especially from landlord panic sales. But first-time buyers in Bay Area and coastal California remain largely priced out despite falling prices, because affordability is still absolutely terrible, even at lower prices. Institutional investors consolidate massive California market share buying from desperate small sellers. Stay with me, because what comes next tells you exactly what you need to do right now based on your situation. Now, what should you actually do with this information? It depends entirely on where you sit in California's collapsing market. If you're a California homeowner with a comfortable mortgage and no plans to move, ignore the noise and ride it out. Your property value might drop significantly, but over the very long term, you'll probably be fine. If you're coming off a fixed-rate deal soon, talk to a mortgage broker right now today, not next month. Understand exactly what California rates you'll face, and whether you can truly afford them. If the numbers genuinely don't work, it might be better to sell now, while you still have equity, rather than waiting until you're forced to sell from total financial ruin. If you're renting in California and thinking about buying, do the brutal math for your specific situation. Don't buy because you feel like you should, or because California real estate always goes up. Buy because the numbers make sense for your plans over the next 7 to 10 years minimum. In some inland regions, buying now makes complete sense. In Bay Area and coastal areas, waiting might be dramatically smarter. If you're an investor with serious capital, pay very close attention. This is the kind of market where generational wealth gets made by people who can see value, where others see catastrophic risk. But you need to be institutional-level professional about it. Conservative numbers, strong cash flow, properties in locations with genuine demand, fundamentals not just tech bubble areas. Don't chase yield in regions with no economic diversity and no future. And if you're a California landlord, make an honest decision about whether you're in this long-term or just hanging on out of stubbornness. If you can't make the numbers work at 6% mortgage rates with California's brutal regulations and taxes, selling might honestly be the right move. But if you have solid properties in strong locations with genuine cash flow that can weather this storm, riding out this difficult period could position you incredibly well when small operators are completely gone. Here's the bottom line. California's property market isn't crashing in a dramatic overnight collapse, but it is tanking slowly and steadily in the most expensive regions. The combination of wealthy residents leaving, higher transfer taxes, higher mortgage rates, brutal regulations, and psychological shift from greed to fear is creating a perfect storm. Bay Area's luxury neighborhoods are cracking. First, just like they always do before major California corrections. Elon Musk and Marc Andreessen leaving was the canary in the coal mine. The pressure is spreading outward, and over the next 2 years, we're going to see California property ownership reshape itself in fundamental ways. The people who understand what's happening, who can read the signals correctly, and who make decisions based on math rather than emotion or California mythology, those are the people who will come out ahead. Whether that means buying at the right time in the right location, selling before you're forced to, or simply holding steady and ignoring the chaos, the key is understanding the reality of California's situation, rather than the propaganda from real estate agents and politicians who desperately need you to keep believing California real estate only goes up. If this breakdown helped you see what's actually happening behind the California headlines, make sure you're subscribed to USA Housing Truth so you don't miss our next deep dive. Hit that like button if this opened your eyes to California's real estate tank. Comment below with California tank if you're watching this unfold. Subscribe and turn on notifications for updates as this crisis develops. Share this with at least 3 people who own or are considering buying in California, because they need to know what's coming. Because what happens over the next 2 years in California is going to determine who builds wealth and who gets completely destroyed financially.